Hi everyone, welcome back. Happy New Year. Hope everyone's doing great. Today I wanted to talk about valuation, right? In the last few videos we covered on the first three, business profile, financial health, earnings and growth. So today is really to talk about the valuation piece. Right. This is a quick recap. If you look at the previous video, which will be in the description box, you would see that we were judging a good business fast by looking at the economic mode, financial health, as well as the future growth. So do look at those videos if you need a recap. So before we dive into the topic, I think one of the quote that is good is from Charlie Munger, right? Which says that a great business at a fair price is much superior to a fair business at a great price. So a good company essentially grows your money. A cheap bad one doesn't, right? And that's important for us to take note of. Valuation itself is, estimating what the business is truly worth from a fundamentals perspective, right? And it's important because if you um, invest in a great company at a very high price, it can become a bad investment, right? Because if you remember early on, your returns are either coming from capital gains or dividends. So a good price can improve the returns over time. And of course, in the process of buying low, you want to sell high, right? So valuation is adding that layer of discipline to your investing decisions. Now, there are many valuation methods out there, but for today, I'll just cover four that I personally use more often, right? The first is PAC ratio, where it's best for growth companies and fast growing stocks. And what I do is we take the price to earnings divided by the earnings growth rate, right? Anything that is one, it's fairly value, and anything that's above or under one is potentially undervalued or expensive. Right. And the second method that I use is the discounted free cash flow. And this is more for stable, mature businesses where they are, generating stable, predictable cash flows. And essentially what we're doing is we're just discounting and estimating what the business is worth based on the future cash flow of the business. Right. The third one that I use also is on price to book. And this is more for banks and asset heavy businesses. And anything that trades below one is where I think, hey, look, there might be an undervalued play here. Anything above one, it could be potentially that it's already overvalued or the market has already priced in strong returns for the business going forward. Last one is price to sales growth ratio, and that's when I use it for companies which have very high revenue growth, but they are not profitable yet, right? So this is one that you want to use when you want to do a bit more speculative, for example, right? You want to get into early plays, right? You want to get that multi-bagger 10x, 20x. You use the price to sales growth ratio as a gauge for that, right? And for me personally, anything that has a price to sales growth ratio that's less than 0.5, that's where it's potentially undervalued, right? And do remember that, different businesses, they use different valuation tools. So no single metric works for every stock, right? So depending on the company profile, use the appropriate valuation method. Right. So let's talk about PAC ratio. So this is an illustration. So let's say I'm using Amazon in this example. And the PAC ratio is designed for companies whereby the earnings are growing meaningfully. Right. It works best when growth is positive and it's forward looking, right? So in this case of Amazon, you can see that they already automatically calculate the PAC ratio for you, 1.4. But in case you're curious how this is being derived, it's basically taking the price to earnings here divided by the EPS over the next 5 years, right? So 32 divided by 20.44 gives you 1.4. And based on the my view is that anything that is below one is potentially undervalued against its growth. And anything that's 1 to 1.5 is fairly valued, right? So in this case, if you can see the price of sales of Amazon, it's about, sorry, not the price of sales, the PAC ratio is 1.4, it means that it's fairly valued, right? So this is one way you can look at it. And all this is easily available through Finviz. The next one that I talk about is price to book. And again, it's used for asset heavy businesses. This is where the balance sheet matters much more than the earnings. And there's also times when a company is turning around, it has many assets in its balance sheet, but it has negative earnings, right? So this is when you can also use the price to book ratio to assess how cheap or how expensive the stock is. So if it's, let's say, between zero point 0.8 to 1.2, I would say that it's pretty much at trading at a fair price to book value. And anything that is like less than or above this range, you can consider it to be cheap or expensive. So again, if you look at taking Bank of America as an example, the price currently is 55.95 as at the time I took this screenshot, and the book value per share was 37.95 that you can see here. So you take 55.95 divided by 37.95, you get 1.47, right? Which matches it here. So in FinViz, a lot of these common ratios like PAC ratio, price to sale, price to book, P ratio, they are all available on FinViz, right? So it's very easy for you to always get this information. And then the third one I'm talking about is price to sales growth ratio. So this again is used for stocks that they are not profitable yet. They are in their early stages of hyper growth. And this is why you want to use the price to sales growth ratio to value them, right? So what you do is essentially you calculate the market cap divided by the annual revenue to get the price of sales. Then you look at analyst reports or analyst estimates to look at the forward revenue compound annual growth rate. You divide this price of sales divided by the growth percentage, and based on, let's say, 0.5, 1, etc., etc., you can then determine whether it's undervalued, expensive, or fair, right? For me, I like to also apply a filter because I want to make sure that while even though I'm investing in these stocks that are not yet profitable, there must be a path to profitability, right? That means if I look at the quarterly statements of the business, I can see that the net income is actually there's a pathway to become profitable, right? And that's important for me, right? Because I don't want the business to just keep constantly burning cash without any return on their investment and on their cash investments, right? So this is one thing that I will apply as a filter to understand the margins and also the gross margins, right? Anything above 50% gross margin means to me, hey, look, there's a potential for it to scale. Right. So this is an example for Grab. So many of you might have used Grab in Southeast Asia. So what I do is you take the market cap divided by the revenue, and you get the price to sales of 6.2. So essentially, as an investor, from a price to sales ratio perspective, you are paying close to 6x today's to the sales of total sales, right? And then if you look at the revenue growth, you look at what is driving the revenue growth, right? Is it expansion into their fintech arm? Is it growth of deliveries, growth of riders, for example? And all this is available out there in analyst estimates, right? So in this case, let's say the analysts estimate that the forward revenue growth over the next 5 years is 30%. I just take 6.2 divided by 30. It's not minus, by the way, it's a mistake here. 6.2 divided by 30, and that's 0.21. Right. So based on this ratio itself, then you can say, hey, look, potentially it's undervalued. The gross margins of the business is improving over time. It looks like the EBITDA trend is turning positive on a quarterly basis, and they are reducing their cash burn, right? So in this kind of speculative stocks, where in the early hyper growth phase, you are not paying 6x sales for today's Grab, right? You are paying for the future value of Grab. You're paying for when Grab becomes profitable, when the margins unlock, right? And you're investing in that future opportunity of the business, right? So it's very important to look at this, right? And again, if you were to use the traditional metrics like the moat, the financial health, a lot of these speculative early growth stocks will definitely fail the moat, fail the financial health because they're still very new, right? So this is something that you bear in mind when you invest in such speculative stocks. Don't go all in, right? Just practice discipline, right? You can invest in money that you are not afraid to lose, right? Then the last one I talk about is discounted cash flow, and discounted cash flow is one that is very famous out there. If you guys do a lot of Google search or look through YouTube, there is multiple videos out there, right? So I'm going to keep it simple. If you guys want more detailed information, you can always look around online, right? So in this case, for discounted cash flow, it is used for businesses where there's predictable cash flow in the future. So for example, Coca-Cola, right? So what you do is you are looking at, let's say, what the current free cash flow is of the business, and then you are assuming how the growth rate will be, right? So let's just look at hypothetical example that we believe that Coke's free cash flow will grow at 5% on a year-on-year basis, right? So you go 5.3, 5.6, 5.9, 6.2, right? So this you do it until, let's say, 5 years or 10 years, right? So once you do that, right, you then will want to go into look at discounting all these cash flows to the present value of today, right? And as a business, right, they can't grow indefinitely at 5% all the time, right? There will be a period, let's say after year 10, year 20, they will grow at maybe a constant rate. And that's what they call as the perpetual growth rate, right? So you estimate what the entire business is worth after, let's say, year 5, right? In this hypothetical example, but assuming that the growth goes forever at that perpetual growth rate, right? Um, Once you do all these methods, you then decided to convert it in a per share value metric, right? So you look at the shares outstanding of the business, you divide the total enterprise value, and then divide it by the number of shares outstanding to get, let's say, in this case, $50, right? So $50 is then sort of your intrinsic value or your fair value of the stock using the discounted cash flow analysis, right? And then you look at, okay, where's today's share price versus the intrinsic value. So I have a hypothetical example that I did for Coca-Cola. This is me playing around with Google Sheets, right? So for example, I'm using Coca-Cola stock symbol KO. I get the price, the shares outstanding. I assume a discount rate of 6% because I feel like, hey, it's a very stable business, so I can use a 6% discount rate. And then I do a forever growth rate or perpetual growth rate. So I would say, hey, I don't think Coca-Cola can grow at like 5% forever. Right. So I use 3% as the perpetual growth rate. So looking at the free cash flow growth rate, I increase the free cash flows based on analyst estimates, right? And then I sum up all the present value of the free cash flow, and then I get enterprise value, right? And then what you do is you then calculate the equity value and find out the intrinsic value, right? So in this case, my valuation says that on a discounted cash flow basis, Coca-Cola is worth $48. And then because I'm more risk adverse, I apply a margin of 60 or 15%. So I only buy Coca-Cola at $40, right? So can I buy it now based on my model? No, right? So again, all these templates and stuff like that, you can always easily find it available online. If there's interest, I will definitely do a more deeper dive into this model, right? And again, what's helpful is that nowadays there are so many analyst reports and brokerage firms out there that gives you free analysis, right? So again, not sponsored by Mumu, but if you look at the under the valuation tab for Coca-Cola, based on the Morningstar analysis research, the fair value by Densu, it says that the Coca value's fair value is $74, right? So again, valuation is an art, not a science. So depending on the inputs you put in terms of the growth, in terms of discount rate, you get very, very different numbers, right? So this is more to equip you with the knowledge. All right, so I've touched upon all the different topics and different common valuation metrics. Thank you so much. If you guys find this helpful, let me know. I'm planning to do more like a live case study, something more in detail. Maybe I can do one particular stock if you guys are interested, do a deep dive all the way from the economic mode, financial health, valuation, right? That's something that we can look together if that's of interest. But anyways, thank you so much. If you guys like this video, do help me to comment, like, share, and subscribe. And I'll see you guys in the next video. Bye bye.